I think, of course, the elephant in the room is APPEC, and it's been very quiet kind of on the Middle Eastern front. And I think that means that I don't think they're looking to change anything soon. And so we just have to look at the cards that we have in our hands.
Hello and welcome to the 6th episode of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital Group, and I'm joined today by Research Associates Mita Chaturvedi and Martha Dowding. Before we start the show, as usual, please like and subscribe to this podcast. I invite you to also visit Onyx's LinkedIn and YouTube pages for more interesting and exciting content. Brent's flat price has experienced a tumultuous couple of weeks since the APPEC gathering in Singapore. It fell briefly below $70 a barrel to recover swiftly to the mid-70s and settle in what seems to be a new trading range, with the 70s now being the new 80s. As we speak, front-month Brent is a little above $75 a barrel, and from a technical perspective, the recent move may have a little bit higher to go, considering that we're not yet in the overbought territory. And the 50-day moving average that could act as a resistance, this is still a couple of dollars above us, around 77. However, the recent rally in Brent came even as the net futures position held by money managers turned marginally negative in the latest 2 weeks of data. And this for us raises red flags, as it signals a persistent hesitancy in the market to increase exposure to oil, and that macro pessimism, notably centered around China, is still a pervasive feature of the market, relegating in the background geopolitical tensions that for now, at least, are considered not to pose a threat to physical oil supply. Some see in the Fed's decision last week to implement an outsized 50 basis point rate cut as a reason to unlock investors' hitherto hesitation to go long oil. But in my view, it's really down to interpretation as to what this decision means for the U.S. economy and what effects it may have on oil. Did the Fed consider it was behind the curve and needed to act swiftly? Or was this decision simply a normalization of the Fed funds rate as the Fed held back this summer from cutting? Only time will tell. But on the eve of a new easing cycle, more liquidity is coming into the markets, and this may raise oil prices alongside that of equity valuations. On the product side, this week, we're going to be revisiting trends in gasoline now that the summer driving season is squarely behind us. Cracks across the major trading hubs have all trended down with weaker demand. However, what happens in the prompt pricing does not necessarily reflect how pricing could evolve further along the curve. After all, even with commodities, the market is still forward-looking. At the same time, there are interesting trends regarding the interregional ARBs that we'll also be taking a closer look at. And from here, I guess we will kick off the show as usual, looking at the changes in Brent positioning. So I'm going to turn to Mita, and Mita, basically, could you give us a rundown in terms of the recent trends in positioning and what have these changes been, and what could we say about them?
Yes, of course. So as many of our listeners would know, ICE Brent futures fell to net negative positions in the week ending 10 September. Following this unprecedented event, we see a lot of de-risking by money managers in Brent futures. So just looking at the COT data that came out on 20th September, that is for the week ending 17th September, we saw managed by money players liquidating over 11,000 lots, that is 18.2% of their long positions, while also removing over 18,000 lots from their shorts, which was, so net positioning, while still remaining negative, did see a small increase because of this exodus of short positions. So it's currently it increased 21% week on week to negative 26.7 thousand. So it's still really short.
If I'm not mistaken, I think the net negative position we had in the last 2 weeks of data was the first net negative position we've had for money managers since records began for this particular series, right?
Yes, exactly. Which is why I think the de-risking was essentially because the fact that Brent fell to net short was probably spooked markets. I think a lot of the shorts leaving the market could also just be profit taking once considering Brent fell below $70 for the first time in over 3 years, But Yes, we definitely saw a lot of de-risking from long position money managers as well. And this de-risking was seen in producers and merchants as well. So producers and merchants were removed both their long and short positions by long positions declined by over 11,000 lots as well. So we did definitely see a risk-off sentiment across the futures.
So what's really interesting, I guess, is we have obviously our traditional risk takers, which are funds, money managers, and but what we're looking at when we drill down into the data is a more broad-based de-risking. So it's not just one category pulling out. It seems to be running across all categories that are available in the commitment of traders data. And I mean, obviously we like looking at the net futures position held by money managers, but the other thing we also like looking at is what is the long-short ratio, because that tends, as you'll see in the chart in this podcast, that tends to correlate fairly well with how prices are doing on Brent. So what is that long-short ratio looking like for money managers?
So it remains below 1 for a second consecutive week, with shorts now over long positions in Brent futures. However, so it's basically unchanged week on week, but we do see a small increase from like 0.85 to 0.80 maybe. It still is fairly unchanged week on week, but yeah, that's where it is right now, like 0.8 to 1.
Yeah, and this hesitancy that we were talking about a little bit earlier, and is really reflected in this ratio, because we're at historically extremely low levels relative to this particular index that we like looking at, and that hesitancy, obviously, if something is going to change the state of mind of the market, then we'll have to be seeing that change within this ratio as well. Now, going a little bit further and drilling down into our risk taker category, we at Onyx, of course, also track CTA positioning. So could you tell us a little bit more about what CTAs have been doing on the listed energy contracts in general, and obviously what interests us most, what have they been doing on Brent?
Yes, of course. So CTAs are still very, very net short, but that is across the crude futures, Brent and WTI, and the products that we're looking at are gas oil, heating oil, and gasoline, RBOB futures. So they're still really net short, although we do see a rise in positioning for all of these futures contracts, which I think that just follows the max short levels that we were seeing just 2 weeks ago. So I think we had reached this extreme short position, and now we're just seeing like a correction upwards across these futures. So Brent and WTI futures recorded a 39%, nearly a 40% increase week on week for both. So Brent's at like negative 30,000 lots and WTI negative 24,000. That is as of the week ending today morning. In oil products, in the middle distillates complex, gas oil and heating oil also climbed up by roughly 25% to the low negative 30,000 handle. And in gasoline, the US RBOB futures recorded a 23% increase in CTA net length week on week, although still net short at negative 37,000 lots.
So I think, you know, when we look at this data, we often tend to bring it back to the flat price. And here I'd like to turn to Martha, because at the end of the day, flat price tells you one thing, but it's always interesting to see whether or not we get the same kind of implications with changes in the shape of the curve. So in the case of Brent, Martha, what have the spreads been doing? Have we been noticing the same sort of pockets of extreme weakness that we saw in the price, or are these holding up a little bit better than could be inferred from what the flat price has been doing itself?
So the Brent spreads are still in backwardation, which shows the market is quote-unquote healthy and there is still some demand. There has been a softening compared to the values that we've seen in the previous weeks, as you know, we have seen in the Brent flat price as well. So the Brent spreads look at the steepness of the curve, but when looking at the shape of the curve, we like to look at the Brent flies. And the longer term flies have seen a really strong increase in the past week or so, maybe a bit longer, which to me shows that the strength we have been seeing in the past week or so, not only from the Libyan outage and the 50 basis point cut, but also the weakness that we have seen from the Chinese financial stimulus, which kind of undermined the market slightly. This is all quite localized into the front. And I think this further shows the undermining of the belief in these stimulus measures from China, because it's not lifting the back end as uniformly as things are impacting the front, as one would hope it would do, which would mean the fly wouldn't blow out to such an extent.
So, I mean, it's quite interesting because obviously when we look at spreads separately, whether it's the current front month spread, the NOV-DEC, or then DEC Jan and so on and so forward. Yes, obviously these spreads move with the flat price, especially at the prompt of the curve. But I think it's a very good way of combining spreads and flies, because now we were actually taking two spreads, putting them together and looking at what has been happening. And so when you find residual strength, and if we look at the backwardation of the prompt month spreads in Brent, yes, these have gone up and then come down, but there is a certain level of backwardation. And then in terms of how the market sees things evolving, it's interesting that, as you pointed out, that the flies are still strong. So for me, there's still residual, as you were pointing out, residual strength at the front. And we're not moving in a situation where somehow the spreads are telling us that there's surplus oil developing that would then require a more flattish or contango shaped curve, a lower flat price at the front, in order to start storing the excess oil for forward usage. Now, as usual, when we talk about crude, we always like getting to our poll, and this is a crystal ball moment, and you'll see in this podcast the results of the poll that we conducted. Now, basically, we asked what would be target price for Brent in Q4 2024, and we have a relatively split view. I think most of the answers are clustering around two options. One is you believe that either we're going to end up between the 70s and 70 to 80 kind of range, and there's a more bearish segment in terms of our respondents that is now looking more for a $60 to $70 range. So, I mean, when it comes to the fundamentals and the backdrop behind this kind of a question, at the end of the day, OPEC hasn't forsaken supply management, but the question is whether or not the market really believes that it is going to be withholding barrels as diligently as it says it's going to do. Now, on the other hand, overall crude inventories in the OECD countries are relatively low, so that in of itself gives us our sort of bullish background to be able to rally off of. Oil demand growth, consensus is now firmly around the 1 million barrel a day mark. And there are obviously some people, which this survey really translates, is who are spooked by the possibility that second half Chinese, not only economic growth, but oil demand growth really comes in lacking. So we have a situation in terms of fundamentals that's not particularly constructive, and geopolitics, even with the rise in tensions recently and the escalation of confrontation between Israel and the Hezbollah group in southern Lebanon, even with that increase in tensions, the market has yet really to react in a bullish fashion. So if I were to ask you guys, I mean, starting with Martha, are you in the sort of 70 to 80 camp, or are you leaning on the more bearish 60 to 70 for the end of Q4?
I think, in my opinion, it will likely be 70 to 80. I think in terms of like actual impetus, I find it hard to be bullish, but with like the reintroduction of the Libyan supply has always been inevitable. Like that's coming back, but so that's been priced in somewhat, and I think the impact that'll have on the refinery margin in particular, the light ends with it being so light and sweet, will be poor. But I think that with the market being so short, there are these bearish things to come, but I don't think we're going to see much of a move down. I think, of course, the elephant in the room is APPEC, and it's been very quiet kind of on the Middle Eastern front. And I think that means that I don't think they're looking to change anything soon. And so we just have to look at the cards that we have in our hands. The data we're seeing is terrible out of China and Europe, but things aren't passing down these levels. The Cushing could be another interesting wildcard to look at. The levels are really low, near operating lows. And I think also you have to consider how short the market is coming into Q4. Players are going to start looking to take their positions off to kind of, get their bonus. And I think that will support the market as well a bit, because the market is really short, so they'll have to buy out of those, which may support prices.
So, more bearish then?
No, more bullish.
Okay,
I feel
because
bearish, but
there was
my
a lot
answer's
on
bullish.
each side on the argumentation. Mita, how do you feel about the extensive list of factors that Martha has laid out? Do you have other factors you think that could help? Your thoughts around what the oil price may end up being at the end of the fourth quarter. Are you also in that bullish camp, or are you a little bit more bearish?
I'm a little bearish from where we are, but I'm not bearish enough to put myself in 60 to 70 territory yet, at least. I'm definitely also in the 70 to 80 camp. I'm technically I think even if prices go below 70, they are going to sort of rebound, which is why I'm in the $70 handle territory right now. I think that is obviously unless OPEC releases their barrels early, which I just don't necessarily see happening. But if something like that happens, or something really bearish, like the Libyan exports coming, that value coming out to be higher than expected, or just something that hasn't been priced in already being put back into the market, I just don't necessarily see prices dipping below 70 for at least just the medium, for just at least this year specifically. But that's so, yeah, unless something like this happens, this ceteris paribus, I would assume we would be range bound. With everyone already so short, as Martha's already said, even though Chinese data is coming out really weak, there might be some semblance of hope with the new stimuli measures, and with just even in the US with the Fed cut and another cut being priced in by the OIS. I think there just is just some level of just some injection of life into the market as well, despite the otherwise bearishness. So I don't think things are going to go above, in the high 70s or above 80, but they're going to be slightly more range bound.
So it seems that we're all more or less on the same board, the 70s being the new 80s. And it's true that you have a sort of natural support when you have inventories at such low levels, because obviously at that juncture, with having very little buffer in terms of immediate supplies, if anything happens from a geopolitical perspective, then obviously that's extremely favorable. The very crowded short position itself tends to lend to a view that at one point or another, investors may come back. So whether they may come back as a result of more liquidity coming back into the market, the Fed cuts, the cuts made by the Chinese central bank in terms of repo rates and other measures they've taken recently. Obviously, there's a number of reasons to think that oil prices have found themselves a new range. And I think it would take something pretty dramatic in terms of the economic data that is not foreseen, whether it be in China or in Europe or the US, for oil prices to shift even into lower gears, and there's that sort of 60 to 70 range. Now, we're going to be turning to products, and as I was saying earlier in this podcast, we're going to be revisiting gasoline. And so you could say, well, the summer driving season is over. What's exciting in gasoline, But what has certainly been interesting is a relatively dramatic decline in cracks, at least the prompt cracks for gasoline, across all the major hubs. So whether we're looking at EBOB, RBOB, Sing 92 in Asia, all of these have come down. So, Martha, do we have a sense of, we could obviously understand that why cracks would come off after the summer driving season. We're now a few weeks after that. Has there been any particular flow of interest really helping to push these cracks down?
I think the selling we've seen in the past few days has come from the strength seen in the week prior. The Libyan oil news that we've mentioned before with being so sweet and light, that's so good for refining. This was bullish for Eastern gasoline in particular, and the cracks have also come off on crude strength. The Libyan news priced in, things were looking a bit overbought, and they seem to have corrected down this week. I think looking at the overall cracks, I think the cracks in the States have been so weak more long term, and just this, slight interesting week we had last week has rounded down to little due to the physicality of the gasoline in the Atlantic basin. Some of this weakness could be attributed to the excess supply, with the European products trapped regionally when the ARB was open, as stocks of gasoline on the East Coast or PAD 1 in ample supply, and the cancellation of some planned refinery works on that area of the States.
Yeah, yeah. So, I mean, it's pretty clear what's happening in the prompt. If we look further along the curve, is there anything interesting from either a crack perspective or even a product diff perspective that has caught your attention?
Yeah, the back end's been really interesting the past month or so. I think, especially, so a couple of weeks ago, we were seeing this Cal 25, Cal 26 bidding, which had kind of, when the market was selling off in Europe in particular, this was kind of bringing a floor to the market. And then we kind of saw that cease, and then there was a bigger sell-off. But then last week we saw this first half of 2025, the gas snap selling there, so the difference between gasoline and naphtha, that differential, we'd seen that been sold into, but then we have seen more buying there. Of course, this could just be profit-taking flow, but I think that's something interesting to look for in the next couple of weeks. If this continues, this could be an interesting place for players to put positions on. Of course, the prices are very low, but...
Well, I think the last point is certainly a very interesting one. Yes, the current summer gasoline season is over. Yes, the cracks are not performing well. But when you have the whole curve, the crack curve, come down as a result of the movement of what's happening in the front, then people will be looking further out, as they tend to usually seasonally build out their positions on gasoline ahead of the next driving season. And for that, of course, we need gasoline cracks to perform. We also need an economic incentive to reform naphtha into gasoline. So I think it's certainly one to look out for in terms of bullish plays. The gasoline doesn't look like much right now, but if you look further along the curve, there could be some interesting developments happening over the next couple of months. I think finally, that there was one thing that caught my eye is, yes, you have this crack weakness globally speaking, but it doesn't mean that there aren't regional differences that are quite striking in the pricing of gasoline. And one of the more striking ones is this Asian premium. Well, actually, it's not in a premium, but at least strength in Singapore gasoline relative to EBOB. What has been happening there?
I think the initial reaction we saw last week and a little the week prior was in reaction to the rate cut news from refineries. And this was coming from China. There's some from Vietnam. There was some gasoline refinery blending being put off starting until next year, until there is better demand. I think this is, of course, this undermines the demand at all, but in the short term, this is bullish. They're not making as much gasoline, and the margins so poor export margins. Domestic stocks aren't high either, which will need to be replenished. And I think looking at the financial aspect, we'd seen really strong bidding of the OCNOV 92 spread and that OCNOV deck fly by the same player. And this had been really supported the curve. Of course, we've corrected a little this week. We've seen MOC a little more mixed this week as well. But I think there could be more strength to come here.
Yeah, I mean, it is quite interesting because China just released its latest batch of product quota exports, and we're not seeing, in terms of the light products, any immense increase. And as you were indicating, I mean, China's export margins for gasoline are relatively weak. reportedly the domestic storage for gasoline is also quite low. So China, which typically adds those marginal barrels into the Asian market, is possibly not going to be there. Stocks, at least those of light distillates measured in Singapore, about average. So it's quite interesting to have an Asian market where I'm sure we're also going to get tenders by the usual regional players to buy gasoline. So whether that's in Indonesia or elsewhere, but we have the situation of a strong Sing 92 versus EBOB, and I don't know when the right time to sell that spread is, but I suppose that it is going to generate some flow of gasoline east of Suez, and with that flow, as we track that flow, this is where the sort of the prompt, at least the strength, which is going to stay with us at least for a little bit, could start giving way, and that becomes an interesting shorting opportunity. Well, what's certainly interesting this afternoon, just jumping off of what you've been saying, is, I mean, we're recording Wednesday, the 25th of September in London in the morning. And so we're going to get the US EIA stats this afternoon. And in particular, you mentioned Cushing, and Cushing, well, the stocks are moving towards tank bottoms. So we're now under 25 million barrels in terms of storage, and you start running into operational problems. I think that if we go even lower, something has to give in terms of time spreads, because while we are experiencing backwardation in WTI time spreads, when you look at the amount of backwardation or the steepness in the first traded months, it's nowhere near the level of steepness we've had for similar levels of storage. So it's quite interesting to see why that is the case, and maybe that's also related to the fact that, you know, regionally or contiguous to Cushing on the Gulf Coast, there's still a lot of crude that wasn't exported as a result of adverse weather patterns affecting the U.S. Gulf Coast. But nonetheless, I think that's certainly a good one to keep an eye out for in the very immediate future, as in this afternoon for us. But with that, I would like to conclude the show. So, Martha, Mita, thank you for joining me today. And until our next episode, once again, don't forget to like and subscribe.